Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, March 13th, 2020. It's 1:48 p.m. Eastern Time as I'm starting this video, and what I'd like to cover today is, in this one, is gold and precious metals and anything related. So that is, as you guys, if you followed me for a while, you've heard me say many times, I think that any analysis on gold is incomplete without analysis of the US dollar. So why don't we start there? This is a weekly chart of gold, but let's talk about that real quick, and I'll tell you why I follow the dollar closely when analyzing the US dollar. So what we're looking at here, this is a long-term chart of GLD, the gold ETF, and what I'm going to do here is overlay the US dollar. We can use UUP. It's an ETN that does a very good job of tracking the dollar, and now what you're seeing is probably a chart that's all over the place. I happen to be a very visual person. I've always, from early on as a kid, pattern recognition, jumping out, spotting things in the wild, a bird, a snake that other people couldn't see, walking in the grass or hiding in a tree or something. And I see things in charts that tend to pop out to me. So what I like to do for people that aren't visual, I want to talk about the inverse relationship between the U.S. dollar and gold. So we're going to start here with UUP, and then I'll flip it around and make that relationship a little more clear. But again, we're talking decades here. We're going back into 2006. That's as far back as I can go here on UUP. That's why we're stopping at that point in time. But you can go back on long-term charting programs for 30-40 years. You'll see the same thing, and that is that the price of gold typically moves inversely or opposite to the US dollar, and the relationship is simple. It's not a magic formula. It's the fact that gold, at least most of the gold traded, there's gold that's traded in euros, other parts around the world, but the gold here we trade, the ETF, GLD, the gold that we're going to invest in the US or buy, whether you're going down to a jewelry store, is priced in US dollars. Therefore, when the dollar rises, it takes fewer dollars to buy an ounce of gold, so the price of gold goes down. And when the US dollar falls, it's going to take more dollars to buy an ounce of gold. So it's really that simple. Don't overcomplicate it. That is why a rising dollar typically is bearish for gold, and a falling dollar is bullish for gold. Now, with the correlation between any two asset classes, there are other factors that come in from time to time, such as supply and demand forces. Maybe there's a higher demand for gold, and you'll get temporary disconnects, and I'll cover that in this video. But what you really want to look at when you're going over these long-term charts, look at the major inflection points. I have gold in yellow, and of course in UUP, the US dollar, in white. So here was a major top in the dollar right there, right? And you can see back then a major bottom in gold. From there, gold started a tremendous bull market, and the dollar started a tremendous bear market. Not mere coincidence that the bear market in the dollar ended when the bull market in gold ended. Gold started its next major bear market. The US dollar started its next major bull market. And they both, peaked around the same time. There was a little peak in the dollar, but another subsequent peak right there. Again, there are times that the disconnect is somewhat temporarily off. But you can see even the little minor trends, the zigs and zags. There it is, dollar up, dollar down. When the dollar was going up, gold was falling, and vice versa. And again, very, very strong correlation. Now, here's how we can do it for the untrained eye. Just flip around. The inverse of the US dollar ETF or ETN is UDN. It's just opposite the dollar. It shorts the dollar instead of goes long. And now that correlation may become a little more clear. And if it doesn't, remember that gold is not priced, and it's not on the same price scale, nor does it move percent for percent with the dollar. So it's not a perfect direct price correlation percentage terms. It's a correlation, one going up, the other going down. So don't pay attention to these differentials in price. Over time, you're going to see that. What you want to pay attention to, again, now that we flipped the dollar upside down, is the trend. If the dollar is going, remember, this UDN up is the dollar down, and now you see I flipped it around to a positive correlation. So you can freeze this screen, study this chart. You are going to see periods of disconnect. This is an unusual period right here. I attribute this. I've been bullish for a while on gold. I think a lot of people like me saw this next bear market coming, knew it was only a matter of time, and we've seen gold's been in a bull market all the way back here since 2016, really. But even then, we've had, the correlation has pretty much been tight until this last move. Now, This is again an unusual large. What this means, the dollar has been rallying in a bull market. I'm going to make the case that that bull market may have ended, has likely ended, and gold yet has still rallied, which is to me uber bullish for gold. Why? Because again, it's overcoming that thing. The dollar was rising, which net is a bullish, a bearish development for gold, because with the rising dollar, it takes fewer dollars to buy an ounce of gold. Yet gold had continued to rise. So to me, I think again that is very bullish that gold has managed to climb so much in spite of a rising dollar. So the big question is, what happens? What happens if I'm right here and the dollar's hit a major major inflection point, and the dollar's poised for a big correction? That would mean UDF. That could really send gold, especially if you get the supply demand dynamics in there, a lot more people wanting to buy gold. It could really send it up through the roof. So we've had some quirky things lately. I'm going to go into the charts here and do that now. Let's talk about gold from a longer term perspective. Let's go to this weekly chart, and let's turn all the lines off for a second so you can see clearly what's happened. Again, this GLD is an ETF, so you can go back when it started trading back in the about 2004 right there. And we can go back and see the last bull market. And by the way, it does a very good job. There's no decay. It's not leverage. It tracks gold almost perfectly. And you can see, there's been smaller bull markets with it, but this was a large secular bull market. Or you could even say a cyclical bull within a much longer secular bull that it's still in. This was a cyclical bull market, cyclical bear market. Gold peaked back in 2011. I had a nice bear market, big drop off the highs. If you're wondering how much that was from where gold peaked in 2011. It fell into the lows of December of 2015. That's when it bottomed, about 44%. And it has clearly been in a bull market since. That's the bottom in December of 2015. And remember, an uptrend is defined as a security making a series of higher highs and higher lows, and that's what we're in now. So when I put that post out there today, I'm going to say, and there's some things, the recent technical developments on gold are extremely bearish. I'm going to say that now and say that it could be the beginning of more, it could even mark the end of the bull market in gold, because this is, again, if I'm going to back out kind of my biases, I'm overriding some technicals right now with fundamental developments. That's why I'm talking a lot, doing a lot of these videos. These are unique times, so I'm going to give you the pros and cons to everything I'm analyzing, and let you guys make your decisions. So as I said, right now, even despite this powerful sell-off, you can still see we're still in an uptrend. We're still in a bull market. Now, what am I talking about here? What's the bearish developments? Well, one of the most powerful, what I found over the years to be one of the most reliable sell signals, especially how simple it is a bearish engulfing candlestick when it comes at the end of an extended run. I ignore them when they come in the middle of a bull trend and it's not very overbought, but when you've had a hell of a run, I'm going to just give you the bearish case now, and we're going to lay it out and get it out there. That is a big, ugly, bearish engulfing candlestick. What does that mean? It means the body of this candle, the fat part, engulfs the previous 1, 2, 3. All you have to do is engulf the body of the previous candle, that one. We've engulfed 1, 2, 3, 4, 5. Hell, you can go back all the way here. I'll measure it out for you. We've engulfed the previous 2.5 months or 9 candlesticks, 9 weeks of candles right there have been engulfed as of this point right now. Day is not over, the week's not over. It'll end today in a few hours, and we'll see where gold does. But it would take a heck of a reversal to undo at least engulfing the previous candle. So I want to say that, and it's certainly given me some pause in my near-term bullish outlook, the fact that this may be a buying opportunity here. There's a lot going on in this market. One of those things I have little doubt is the unwinding of it is the largest margin bubble in history. You can go back. I'm sorry, I don't have a chart in front of me. I've posted it in the past. Google search NYSE margin interest or margin debt, and you'll get a chart, and it'll show you where margin debt was back at the top of the 2007 bull market top and where it was recently. Now, it peaked out actually a few months back. It didn't just peak out at the market highs here, but it's been falling, and it's still huge. So where I'm going with that is when the market drops as it has, and the credit bond bubble blew up like I talked about. Yes, they're up today, but that's nothing goes down forever. I'm very comfortable with shorting back into the LQD today. And yes, the market's rallying, but as I told you yesterday, I suspected this is a point we might get a bounce in the market. The odds were pretty decent. So all that is normal. Nothing goes down forever, especially when you're extremely oversold. So with that being said, this is very very bearish candle. What else is there to show you? Oh, and the recent divergent high. Let's turn back on all the trend lines here, annotations. This gives me pause. Otherwise, I would have added gold as an official trade today, official long trade. We've had it long in the past and short, but right now, these are the things I look for major tops. This is negative divergence on the weekly time frame, just like we have on the stock market. And this, to me, usually means the end of a bullish trend, especially when you have the sell signal. The divergences themselves, I always say this, are not sell signals. Overbought conditions are not sell signals. They're merely indications that a trend reversal may be likely. And then what you look for is a sell signal, which can come on a break of a well-defined support level, a bearish chart pattern, an uptrend line. I don't have really a solid uptrend line. As you can see, I'm not going to force one here. Yeah, I can connect these, but I always say 2 points can be connected at random. It takes a third reaction, and we didn't have a reaction here. We sliced right through it. So I'm not going to use that trend line right there. I'm going to say that gold did have minor, some support here. The biggest, really all that stands out to me other than the divergence, and it's the fact we have this bearish engulfing candle on the heels of this divergence like that. If it just was a random bearish candle, no divergences, when we were still above support, I might say, whatever. Sometimes you get them and you continue, the advance continues. So that gets the negative stuff out of the way. And if it does pull back, it doesn't mean that it has to be the end of the bull market, although it could. Where would you look to buy back into gold? Where should gold quote unquote hold up? I'm going to add one more level. This was a big level right here, so I need to add a line. I haven't modified this weekly chart in a while. Here's your support levels right here, about 143.87, give or take. And remember, big moves in this kind of volatile market, so you can slice through. So we're effectively at support now, where I think gold is going to hold, at least for a tradable bounce, and quite possibly, that's why I do this video. For those of you, I've been preaching the benefits of asset allocation and having gold as part of your long-term investment account for quite some time now. And for those that have been looking to either add to or even start a position but just didn't want to chase it, you could take a shot here. Like I said, it could keep going down. I wish we didn't have this bearish engulfing candle. I'd feel more confident, and I would most likely be adding it as an official trade. But it could hold here. And again, this just could be forced margin selling in gold, is what I was talking about earlier, which once that's cleared out, we could get another big leg up. And again, I'm going to roll back into the US dollar and the short-term charts of gold and even silver here. So there it is. Gold's at support. If that level holds, we keep going down. Here's your next support at 137.20. How far is that? That would be, give or take, from where we are. I can't grab the line or it moves. Grabbed about where we are in price. That's about another 4% down. And then the downtrend line below that, it could be, depends where we hit it, all the way down about 7%. Uptrend line there. You've got a few reactions there. And then a big, big level. I was harping on 130 for a long time. That was a very important level. We had multiple reactions over years right there, where gold was tapping up against that level, basing right here, and boom, powerful breakout. So if things get really ugly, that would be a level I'd be very, very interested in adding gold as an official long if it gets there. By all accounts, technically it looks like it could based on what happened today, but I'm kind of overriding what I'm seeing here on the charts to a good degree right now, based on some of the fundamental things going on, as well as what I'm about to get to in here in a second in the US dollar. So those are the levels to watch. This is still my longer term next bull market target in gold, up there about 170, almost 174. Daily chart, what do I see in gold? Well, it was pointed out recently, these divergent highs, they often work. There was your negative divergence. We had a divergent high here. We had a divergent high here. We had from those divergent highs, we had a correction, and that was just a correction within a bull market, followed by another leg up, divergent high. So you just have to respect these divergent highs. They don't always mean the top, but these were corrections that we were able to sidestep. We were long at some point here, book gains. I throw these trades out here, official, unofficial, at different times. I'm always going to provide analysis on gold. And that's the most recent divergent high. And what you look at here, you really have, although I marked it as a small divergent high there, which it was, you have from this peak to this peak in the RSI and in the MACD, right here on the RSI as well. So you have divergence from there. But you also have continued divergence from this high here. And that's what shows through. That's what I showed you on the weekly chart, that bigger divergent high right here. So that is, again, no way to spin that technically as anything but bearish. And of course, we've had a pretty impulsive sell-off so far. Okay, and on this daily chart, you can see, we'll call them micro levels, micro support level. These were resistance levels I had on the way up. I really haven't even modified this much recently, but pretty big level, really big level there, about 136.58 if we continue lower. If you're looking for, levels, so far a reversal off that we overshot that 142.58. Again, I put up some charts on the home page today, and we've overshot that 142.58 level. And here's that trend line off the lows right there that comes in around that 130 level I showed you on the weekly. So those are big levels. And again, I'm favoring this more to be a false. It is what it is so far. It's a correction, but I'm leaning towards it not being the top, and the gold at some point, whether it's today, within the next few weeks, a couple months here, if it comes down there, to go on and resume the bull market and prove that bullish, that bearish engulfing candle did not mark the end of the bull run. This is the GC gold futures contract. By the way, guys, there's mini contracts. If you like, if you're a futures trader and the big contracts are too much, I mean. They have, gosh, what is it? On silver, I think it's QI, and on gold, I'll have to look it up. Just Google search, gold futures mini contract. You'll see the symbol. Or if if you haven't found it, just ask me below this post in the comment section. I'll post those. But what's nice about the minis, just like the S&P 500 E-minis and the NASDAQ, NQ, and ES that I post all the time, you have MNQ, which is the mini NASDAQ 100 futures. MES, you have R2K, which are the mini Russell futures, and they trade on the same exact levels as the big contract. They just use a smaller leverage factor, so I don't have to post two separate charts. If you're trading the mini futures of gold, you can use my GC levels and align it with your own levels, and even trade that smaller size contract again. And if you don't know what futures are, how to trade them, what the risks are, what the leverage, stay away. Stick with the ETFs at best, again, if you have that comfort level. What I see here, what I spy with my little eye was a bear flag pattern right there, that consolidation, big impulsive move leading down, and a move so far that it pretty much meets the measured target, which is this impulsive move called the flagpole on the way down leading up to the consolidation. Now, I made a big mess of that, but there, you can see it, and we'll tighten it up a little bit here. Let's just zoom in. There it is. So to me, it looks like a bear flag pattern. It's not the perfect, most cleanest flag, if you will, but it pretty much meets the measure target, and it hits that's that support zone that I posted today on the site earlier, saying where I expected a reversal even if we had a brief overshoot, which we did. And there's a minimum bounce target right there, 1549. And when I say minimum, two ways to trade it. You can either trail stops up, set a stop if you went long, hold it, and either book profits. You want to maybe a little shy the actual resistance level, which is around 1550, or if it plays out, you can just ratchet your stops up along the way, give it a little bit of room for reaction there. You probably at least get a reaction, and allow for a potential runner trade, because this could prove to be, this correction could prove to be the next great buying op on the road to new highs in gold. A lot of work to be done technically. Again, it's just me kind of speculating with what's going on here and what may develop going forward in the financial markets, including the US dollar, including the stock market, including gold. But there's a lot that goes into my analysis, and one of that has to really loop back to treasury bonds. well, it's not really getting off topic because it all goes into my thought process here. The treasury bonds, as I've said, have, to me, at least as of the other day, I said very poor risk-reward ratio, meaning minimal upside potential, because the fact that the 10 and even all the way out to the 30-year bonds are getting near zero, so there's no more upside potential in bond prices. It's a suicidal trade, in my opinion. Even though that is considered, I've always said this: treasury bonds are the king of risk-off assets. When financial instability, financial markets are unstable, dropping, corrections, that's where historically institutions have flocked to. But never in history have we had the 30-year bond and the 10-year bond this low. So therefore, times are different now. And so again, I think it's financial suicide for those that were buying treasury bonds the other day. Not to say that they couldn't go up a little, because rates weren't at zero on the 30-year and at zero on the 10-year, but they were getting darn close. Not to say they can't go into negative rates, but I think that's unlikely. And if it does, you're not going to negative 5%. The negative goes incrementally in small basis points, fraction of percentage, if the U.S. gets to that point. So therefore, like I said, there's very little upside potential because bond prices are directly determined by their interest rates, on treasury bonds particularly. And so where am I going with all this? Okay, well, I always said TLT or treasury bonds were the king of risk-off assets, and then number two behind that was gold. And so now that's eliminated this, to me, as a viable option. Now they pulled back a little, so look, don't get me wrong. Treasuries have had a pullback, so I think we're going to get another leg up as soon as the stock market takes another leg down. If and when it does. Where we go, whether we go to new highs, whether we go partially there, I don't know. I don't care. I'm just staying away from that one. But like I said, I think individuals and institutions are going to realize, hey, I don't have many options to hide out in this market. I can go to cash and earn nothing. What might go up, and it might be gold. So what I'm doing here is making a fundamental case, and despite of a pretty bearish technical posture and recent developments on gold right now. So let's go back to the future. And like I said, so far so good on the the reversal and successful defense, even though we had an overshoot. And I talk about this often. I know if you're a subscriber, you're going to hear me repeat the same things over and over, but there's always new people coming in. I refer to, it's a term I made up called a momentum-fueled overshoot. When you have a lot of downward or upward velocity on a security, in this case a near vertical plunge, it is almost more than common and almost to be expected that if I was right calling for this level to hold support, that you're going to overshoot it briefly and then snap back and get above it. So this is, I consider it a successful defense of support. If we had meandered on down there, chances are you would have bounced right off the support. But I use this term momentum-fueled overshoot, and I use the analogy in baseball, a pitcher throwing a 90+ mile an hour fastball. He hits that catcher's glove. It's not going to stop cold. The catcher's glove is going to snap back in his wrist, and his wrist is going to snap back forward afterwards. And that's the analogy I use there. So far I see a bear flag that's played out to the measured target and a reversal off support. And so therefore, I think we can bounce more up to at least that 1550-ish target, and quite possibly more. I give you the two strategies on whether you want to just trail stops and let it run. Let's look at the daily chart of gold. Okay, and like the GLD, hard to spin this as anything but bearish. Well, earlier today, because we had taken out both this trend line here and potential trend line. We had two reactions there, but we had a pretty well-defined support level at 1538. We took it out, but so far it's pretty much a momentum-fueled overshoot. We're almost back there now. We're at 1532 now. So if it can regain that level, you have the potential for a bear trap. A bear trap is when you break support, shorts pile in, thinking, oh, support's broken, we're going down here to 1469 or below, and then when it reverses and regains support, they realize they were wrong, their positions start to go underwater, and they start to cover. And when a short covers their positions, they're buying the security. They're buying gold futures or GLD. So that is one potential scenario. And again, yes, we had the divergent high right here that's shown on the 60-minute chart or daily chart we're looking at. But then again, we also had a drop so far of 12%. So is that enough? And it may be. You know, I pointed out back here on the chart I had all the divergences drawn out. We had a divergent high here. We're in a bull market in gold, so you know these divergences are going to play out for a correction, and that one did. And it was pointed out at the time in advance. It played out for an 8 or 8.5% pullback, and it was enough. And so the divergences, the technicals played out, and gold resumed its bull market. Now this was a lot faster, bigger drop, but here's the key to trading a bear market and a correction. Done this before, and I say it often. Stocks tend to fall a lot faster than they rise. So you got to be Johnny on the spot. You got to look at these things ahead of time, figure out how you want to trade it, because you don't have a couple days or a couple weeks. Sometimes you don't even have a couple hours to move. Once you know you're looking for this pullback. Let's say you're expecting gold to drop here, and if you wait a couple days to see if you were right, the move's over, and gold could be, you know, have retraced most or even all of that drop. So all I'm trying to say is you're going to see a lot of some semi-aggressive trades by me, trying to get in front of things. You know, sometimes when you try to catch a falling knife, quite often you can get cut. So stops are a must. Where you put your stops is going to depend on a lot of factors: your own risk tolerance, your own price targets, where you think the security is going. I'm going to add another level as I'm talking to you. I just see a level right here, a little bit below. I see some support there. And we pretty much hit it anyways, about 1500. You can see some reactions there. So that's it. Potential bear trap scenario right there in gold. And now let's talk the dollar. Okay, I will use the US dollar index. That's $USD. This charting platform used to have it. Now I have to go to my stock charts or another one, which I have on another monitor. I'll also like to use the Euro US dollar Forex pair, because the Euro is and always has been the largest component. It's about 56 point something percent, I believe, of the US dollar index. So more than half of the dollar index is attributed to solely what the euro does. The Japanese yen is a distant second. Everything else you can add in, Swiss franc, all the other currencies, they're not going to really move the needle so much compared to this one. So if you want to know where the dollar is going, it's just an inverse or opposite of this chart. And so what we have here, you can see everything marked on here, and go back in time, screenshot this, see where these trend line breaks go, and you have a correction, trend line break. And the euro has been in a bear market against the dollar for quite a while, but you can see these divergent lows right here. We had strong positive divergence. You had a trend line break, which was your buy signal. Remember, the divergence wasn't. I was highlighting this divergence for a while there, and it finally played out right here and then broke out, and you got this uptrend, which ended in a divergent high plus a run into resistance there at about 126 or so. And then you had the sell signal, again pointed out at the time. Sell signal came, and that started this new bearish trend in the euro, which again, this is the opposite. So the dollar was rising. And then finally, I pointed out recently, we've been building for a while positive or bullish divergences, just like before. Zoom in a little bit, we hit this support level, and we had a breakout right here, this price channel right here. Price channel would be defined by, most important is the uptrend line that caps all the advances, and then the bottom of the channel there. So we had an impulsive breakout last week, right? We're on a weekly chart here, and we ran right up. I had that 14,939 resistance level there before. That's a big level. See, why is it a big level? Well, we had a massive basing pattern here for the euro US dollar, which broke out right there, and then we fell back. It held as support. We broke below it, and then it was resistance. Big level. So it's perfectly normal that we reversed there after the breakout and pulled back, and now we're back testing. So where we go from here, where I think we go, I think this holds up. So I mean, the euro reverses, makes another run at that level, ultimately breaks out. If so, that means dollar down, and if so, that means bullish for gold. Otherwise, if we come back down and it's a failed breakout, especially if we take out these recent lows, that means the dollar's rallying, and that's doesn't mean gold can't go up, but it's just saying it's not a good sign for gold. It's going to give net, you know, factor out other supply and demand forces. The you know, rising dollar is going to be bearish for gold. So right now I'm on this scenario where we're about to have the next leg up in the euro, next leg down in the dollar. We can look at the euro monthly chart right here, euro US dollar monthly. Yeah, I don't have any annotations on here. You can It's interesting to note, here's that same 20-month exponential moving average I use on the stock market on SPY and QQQ, and it does a good job of defining bull and bear markets. There's a little bit of whippiness here, but for the most part, when you're below that 20-month, the trend is bearish and it acts as resistance. When you backtest it in a bear market, then euro US dollar broke out there, you're bullish, crossed back below, and then it was resistance all this time. Look how we've been pushing down against it. So we popped it intra-month, meaning earlier this month, but this monthly candle hasn't finalized. So keep an eye on this. You know, in other words, it all kind of hinges on where we're at now. If the euro US dollar can reverse soon, it means the dollar starts to take another leg down, the euro moves up, you have the chance to close above that and put a buy signal here on this more significant monthly chart. On the weekly, you'd also see a reversal, meaning a successful back test to the top of that channel. And then again, the big level to watch is still going to be that recent high around 114, 115, really rounded off. These things trade out, you know, to pips here, so it's there 115, we'll call it. That's the big level to watch, and that would open the door. You know, we're starting a new bull market in the euro, a new bear market in the dollar, and this is UUP. There's a big bearish rising wedge, broke down, and you can see I'm rolling back here. The UUP, the dollar ETF, has had major resistance up here, and these three lines are a big resistance zone. And we've had multiple failures here in recent years, and it's really capped all the advances in the dollar. And we finally broke down, had a little back test to that midpoint of the zone, and we're up there again back testing. So this is what tells me. A lot of this stuff tells me that just like before when we had the negative divergence here, it ended up in a correction. Back here at this high when we were rejected, we didn't have negative divergence at the time. In fact, we were just coming off this bullish divergent low, which led to that rally. So we had a correction, put up, made a new high, but that was a divergent high at resistance. Boom, big correction that followed right here. This time around, we pushed up, we hit the top of the zone here, we went a little higher, and we finally put in negative divergence at that high, and I see this is the most probable scenario for the dollar, and that if that is the case, again, that by itself would be a bearish development. I'm sorry, a bullish development for gold. And if you get other people thinking the same thing I am, that hey, there are not a lot of options to make money in this bear market. Treasuries have limited upside, so why don't I put some more money in gold? Then you could see a case for a very nice rally in gold. Silver, remember, gold is really the flight to safety asset. Silver follows gold, only there's a gold to silver ratio. They have similar uses. They're both precious metals, and they both have industrial uses. Silver, I think, probably you'd say a little more of an industrial use because it's, you know, cheaper metal, and for whatever reason, and so it's a little more prone to the economic cycle. And again, it gets a little less of a flight to safety bid. People don't think the first thing you think of when you're talking about socking money away for an inflation hedge or a stock market hedge is gold, and then silver. I call silver gold's baby brother. So the chart on silver, the weekly chart, is not as bullish as gold. I showed you gold in a clear uptrend since 2015, but I can't really say the same thing on the long-term uptrend on silver, because silver's just been in a multi-year trading range since those low, actually all the way back here. And you can see even the top of that range was support back here. So there's just a big range. However, we can look at it this way. Silver is at the bottom of the range. It's TA 101, Technical Analysis 101, or Trading 101. When you recognize a trading range, keep it simple. Use the old KISS rule. Keep it simple, stupid, and simply go long at the bottom of the range and go short or sell your position at the top of the range until it stops working. So you would have been rewarded going long here, holding to there, selling, going short there, or waiting here to buy. You made it in the midpoint of the range. I've always pointed this out too. I've noticed over the years it's almost uncanny. Any range, whether it's a price channel like this that's upward sloping or downward sloping, you get a price channel on a stock, you'll notice you can usually put a line right about in the middle that often acts as support or resistance within that trend. And when the security breaks, then it goes down to the bottom, and when it breaks above, it goes back to the top of the channel. And that's also the same you can see here. So that's kind of a little takeaway. If you're not going to swing for the fences, for a move all the way up, you could at least swing for a move to the midpoint of the range. And then when you trade these ranges, look, 1 day sooner or later, you're going to have a breakout to the upside, which is very bullish, especially the longer the range lasts. That's a basing pattern or a consolidation zone, or you get a break to the downside. Whipsaws are pretty common in this market, so you can get a little whipsaw. But if you get a solid break and you can see it's anything more than just a little brief whipsaw, that could and is likely to determine the next longer term trend in silver. So I want to throw caution out there that I'm going to sit here and tell you that I think, especially gold's going up, and I think silver is about to bounce with it. We put in that divergent high. One heck of a correction in silver recently, and again, I think this was a large part of margin selling right there. And again, silver has an industrial use, and so with the economy clearly turning rapidly, the economic outlook due to the COVID-19 scare or whatever, pandemic, let's call it what it is. You have a 24% drop in short order. You have a potential uptrend line here, and then you have a big level here. I'll brighten it up, about $13 on SLV. The SLV is the ETF. I like to look at the futures, and I gave you a chart of that. Today, silver futures are actually at support, or at least were when I posted that chart. Let me find them here for you. There it is. So this is a daily chart, 2-year daily candlesticks, and you can see that silver is at that level. Maybe a momentum fueled overshoot. That's what I suspect it is. Last time, if you stepped in when we were this oversold, this is the RSI. I don't have my oversold level at 30 like most charting programs will put it. I like to use my own custom overbought and oversold readings on I go back for the last 2 years. I can see that silver, the lowest extreme it ever got to was the same level, just around there, around 22, and it hit it there. It actually did go a little lower, and then it put in a divergent low. So that's something to look for if we get there. However, I'm putting a little bit higher weighting on the fact that we have some pretty darn good support here. Every time in the last couple of years silver has fallen to about this 1450-ish level, they were buying opportunities, whether it was a quick bounce or you held it and held on, and really, if you held from there, you never went underwater, and you would have got all of this potentially. Of course, that's if you held it and then sold the highs. But I just wanted to make mention that that's a hell of a oversold reading. Big drop, slight momentum fueled overshoot. This market, anything can happen. We can continue to unwind this credit bubble, and holders of silver, if there's too many, they're going to get squeezed out. They're going to have margin calls, forced selling, and all that stuff. So, don't fall in love with this trade. But, I think it's objective here, even though it's a little below support, or a little bit less aggressive strategy is to wait to see if we do get a snap back above. We do recover back above 1460. That will, help firm up the case this was a momentum fueled overshoot. Silver will regain that level, which then puts into play the potential for a bear trap scenario and a decent pop. I'll give you another shorter term level. You can see some targets overhead, but I'll put one right about here. That's about 15,195 if we get a reversal. And again, don't like anything, don't fall in love with it. Don't put too much into it. This is a volatile market. Silver's down, 9% today. Do the math on that. Anytime you take a position, don't just look at dollar signs, how much you can make if the bounce targets are hit. Look at your loss potential if your stop loss is hit. And again, this is not the kind of market to fall in love with something and not use stops, because as if you haven't noticed lately, in very short order you can on even on the stock market, you can lose 15-20% in a matter of just days or weeks here. I was just marking that divergent high that wasn't marked. All right, that's it. Let me get this out to you guys. There's, I can go over platinum, palladium, but let's just focus on these now, because these two tend to move closest in concert, silver and gold. And again, like I said, gold tends to get the more of the flight to safety bid. But what happens is silver tends to play a game of catch-up. It tends to swing down more in the corrections and sometimes go up more in the rallies. And then gold will sometimes go up. And I noticed, I caught that for you guys back here. I said I favored silver. I thought it would play a game of catch-up to gold, and it did. It had an explosive rally, vastly outperforming gold, because gold had held up and was way up, and silver had lagged behind. And the charts on gold and silver were both constructive. So in that case, I said, silver may outperform. Hard for me to say that this time around, even though silver is knocked down, because again, gold is the king of flight to safety. People are going to flock to gold. typically before silver. So the easy way I like to split the difference, have a little of both if you are bullish, and sometimes one will be the big winner, and sometimes the other one will be the big winner, and it kind of washes out. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.